Good day to all. In this video, we are going to see about essentials of banking system, credit creation and functions of central bank, that is Reserve Bank of India. Let us enter into the subject. Yes, what are the essentials of sound banking system? There are four essentials. First one is adequate liquidity. Next one is expansion of banking, investment and loan policies, human factor. That is, the bank must keep sufficient cash in hand to meet the claim of the depositors, because the depositors deposit money into the bank. The deposited money is converted into loan and it is given to the borrowers. And whenever the depositors come to bank and demand money by giving withdrawal slip, means the bank must have sufficient amount of money in their hand to satisfy the needs of the depositors. Otherwise, they would be insolvent. So the bank must have a sufficient amount of cash in hand to meet the demands of the customers. Expansion of banking. Yes, banking facilities should spread throughout the country. It cover all sections of people. That is, banks are available in rural area, urban area, developed area, backward area. So the expansion of banking helps to remove regional imbalances. Investment and loan policies. A sound banking system must have a sound investment policy. While investing money, the bank has to consider whether the investments are feasible, whether there is a possibility of earning income from the investment. After that, the money will be invested. Okay, and human factor. Yes, the bank employees should serve the customers with smile. The soundness of the bank depends upon the quality of the banker. The smiling face of the banker will attract the customer towards the bank. So sound banking depends on banking personnel than banking laws, because banking laws are nothing but a document, because the bank customers are a soul, so they are satisfied by the bank employees. And next one is credit creation by commercial banks. A small example is given here. Yes, a commercial bank is called a dealer of credit because it mobilizes funds from the public and it is converted into credit and given to needy people. For example, a bank receives a sum of rupees 1000 as deposit, means from the amount of deposit 1000, it keep rupees 20% of cash reserve ratio. So it kept 20% 200 rupees as cash reserve ratio and the remaining 800 is given as loan. So the depositor will claim only has 1000 and the banker borrow to possess rupees 800. So the total money supply appears to be 1800. That is, deposit amount is 1000 and the loan given is 800. So 1800. It is a credit creation by single bank. In the above example, suppose 800 is deposited in another bank, means that another bank keep 20% of reserve. So from 800, 20% means 160. So 160 is the cash reserve, remaining 640 is given as loan. And if the amount to 640 is deposited in another bank, means again this 20% is charged. 128 is kept as cash reserve ratio and 512 will be lended. So this process continues and without going fall. It helps to maintain a liquidity. Okay, this is credit creation. And limitations of credit creation. Much depends on the size of the cash reserve ratio, because 20% is considered as a much size of the cash reserve ratio. And if it is cent percent, multiplier will be 0. And if it is converted into cent percentage, the multiplier will be 0. So there is an inverse relationship between CRR and the size of credit multiplier. And a credit creation depends upon the amount of loan given. If the society does not borrow, it happens in a period of economic depression, because in a COVID-19 period, everyone need money because they cannot reach bank. So during the economic depression, bank can neither lend nor can create loan. So if borrowers cannot offer security against loan, banks cannot lend. And size of the cash deposit is an important concept. The smaller the cash, base, the smaller scope a bank gets for credit creation. So size of the cash capacity is low means the bank cannot create large amount of loan. The bank can lend money against acceptable securities. A borrower get a loan from a bank only against some securities, because while applying for loan, the bank asks the security from the customer. If fixed security or movable security is held by the customer, the bank will give loan. The credit creating power of the commercial bank is substantially controlled by the central bank. The commercial bank cannot lend loan on their own desire. With the directions given by Central Bank of India, that is RBI, they can lend money to the people. And let us see about central bank. What is central bank? It is a banker's bank. It is Reserve Bank of India. What are the functions of central bank? Yes, note issue. Central bank has a monopoly power to issue notes. So, and not except 1 rupee note and coin. 1 rupee note are issued by Government of India under the guidance of RBI. The currency notes are issued by central bank and declared unlimited legal tender throughout the country. The central bank has to keep reserve of gold, silver and foreign securities for issuing notes. So, the note issue is made by central bank as monopoly. And banker, agent, advisor to the government. Central bank act as a banker, agent and advisor to the government. Whenever central government is in a problem or financial crisis, immediately the Prime Minister asks the RBI governor for help. So the RBI governor gives some instructions, advice to the government. And next one is banker's bank. Yes, commercial bank is known as banker's bank because all commercial banks, cooperative banks are under the control of central bank. So according to Banking Regulation Act 1949, central bank has a power to control all other banks. So it is known as banker's bank. And clearing house facility is check clearing facility is performed by central bank. Is clearing house operation, interbank transfer of funds, settlements of account. An example is given. Indian bank has to pay rupees 2 lakh to SBI, and SBI has to pay Indian bank rupees 1,50,000. So now this can be settled with the check of rupees 50,000 by Indian bank. Instead of transferring 2 lakhs and 1,50,000, a remaining balance 50,000 is settled by Indian bank. And custodian of foreign exchange reserves. And RBI controls both receipts and payments of foreign exchange. It acts as an agent for regional imbalances, that is balance of payments. A country has its foreign trade favorable or unfavorable balance. Favorable balance means exports are greater. Unfavorable balance means imports are greater. So in order to balance this, the RBI acts as a custodian of foreign exchange reserves. Credit control. The credit control is done by central bank because the commercial banks do not lend money to the needy people as their own desire, because each and every time they have to maintain a cash reserve ratio with the RBI, and as per the lending rules given by the RBI, the commercial banks lend money to the people. So the credit control is done by RBI. Credit control by central bank. How it control? That is, we said that RBI control credit given by commercial banks. What are the instruments used by central bank to control credit? And let us see about first control weapons. The central bank possesses number of instruments for controlling credit money. And first one is, there are two types: quantitative methods, qualitative methods. Quantitative methods means bank rate policy. Yes, the central bank lends money or rediscounts the bill of commercial banks. The rate of interest charged by central bank is known as bank rate or discount rate. So central bank lend money to the banks and they fix a rate. That rate is called bank rate. By manipulating bank rate, the central bank regulates the credit power. A bank rate is raised by the central bank means the commercial banks are to borrow at a higher rate, that is higher cost, and they will increase their lending rate. The rate is known as market rate. So the difference between market rate and bank rate is the profit margin of commercial banks. Okay, so by using this bank rate policy, the RBI control credit. And next one is Open market operation. In an open market operation, RBI purchase and sell securities. When central government appears to be in the market as a seller of government securities. When inflation is there in an economy. Inflation means everyone has money in their own hand. At that time, the RBI sells securities in the open market. So now public buy the securities and the money in the hands of the public or transferred to RBI. Okay, and now the imbalance, that is inflation position, is solved. At the time of deflation, deflation means people has no money in their hands. At the time, RBI purchase securities from the public. Now RBI give money to the securities, give money value of securities to the public. So by purchasing and selling securities, inflation and deflation are controlled by RBI. And next one is variation of reserve ratio. Yes, commercial banks largely bound to keep a portion of their deposits in the form of cash reserve. Naturally, by altering the cash reserve ratio, we already know that 20% is a cash reserve ratio, the central bank can expand or reduce the funds bank can lend. So by increasing or decreasing the cash reserve ratio, it can control the credit. If cash reserve ratio is increased, means the lending amount is reduced. If cash reserve ratio is reduced, means lending amount will be expanded.